Hi there. Thanks for joining us this evening. I'm Shervin Joseph, a diversity outreach manager and mortgage loan officer with Fitzgerald Financial, a division of TowneBank Mortgage. Alongside me is Sean Higgins, vice with United One, and we're here to present you with literacy mortgage training tonight, mortgage and credit training. This is the fourth installment of a four-part series. It's been just a joy to be partners with the Washington Informer. This is our second four-part series, and we will be doing another four-part series a few months from now. But this tonight, we really want to embrace you and implore you to ask as many questions as possible so you could have any questions in your mind. However, I plan on doing a presentation, a mortgage 101, just to, rekindle the flame of the first episode we did 4 installments ago in the series. And Sean is going to do his credit piece, which is always amazing. And it kind of just meshes together the credit and mortgages. You can't get anywhere without credit, and you need credit to start before you get into the mortgage process. So with all of that said, I'm going to introduce a man that has 30 years experience in the credit world and will discuss with you everything credit. Nobody does it better. Sean Higgins.
Thanks, Shervin. As always, I always enjoy doing these presentations with you. We're old hat at doing these, aren't we, Shervin?
Yes, we are. Yes, yes. Close to 17 years now, and it's easy. It's like an old married couple. We just know where each other's going.
That's right. That's right. Thank you, Shervin. So, as Shervin has said, this is our fourth one, and very much appreciate to be here tonight. Just a couple of things to talk about. One of my goals is to reach people tonight. I want to make sure that people really understand what actually happens in the with credit, so they have a good understanding of it. Because as Shervin so eloquently said, it all starts with credit. So I have a presentation I'm going to put up on the screen right now, and we're going to talk about some information as it relates to credit. So a couple of things up front and first. I'm not a credit repair guy. I'm a credit reporting agency. Shervin will back me up on this, that there's probably not a good choice to get involved with a credit repair agency. They'll take money, they'll make promises, and really there's a lot of better things you could do with that money. So my contact information is there. I'm based in Pennsylvania. As Shervin said, I'm in my 31st year in this business. Very fortunate to have Shervin's company, which is Fitzgerald Financial, as a client of mine, and spend a lot of time working with Shervin and all the good loan officers at Fitzgerald, providing them with credit reports, looking for opportunities to improve consumers' credit scores, and hopefully get more people into houses. That's really my goal. So my presentation, as I said, it's got my information up front, and I'm going to get right into it. So I'll start very, very broad, talk about what is credit scoring so that you understand what that is, and then we'll get into a lot of the different elements of credit scoring. So credit scoring is really, it's a measure. The definition of credit scoring is a measure of the risk of default of a borrower. So a lender wants to make sure that a borrower has the capacity to pay back their loan. And the credit score is as Shervin said, the very beginning of the process. So in credit reporting, there are three national credit reporting agencies. There's TransUnion, there's Experian, and there's Equifax. And then the credit score that we use in mortgage credit reporting is the FICO score version 8. The way I always like to explain how a credit score is calculated and how it actually appears on your file is, think about a race. If you were running a race, there's going to be somebody at the end of that race, a competitive race with a stopwatch that's going to click it as you cross. So what happens is the lender will access your credit report, and at that time, that credit report gets accessed, and then a score is appended. Okay, so the score is calculated on the fly based on the information that sits inside your credit report. One of the things that you're going to hear me talk a little bit about as we get into this process is the term credit fitness. And I'm a proponent of credit fitness in the fact that it allows consumers to have a good indication of what's actually in their credit files. So you'll hear me talk about that. There's two really, really good places to get a copy of your credit report. One is called annualcreditreport.com, and the second one is Credit Karma. You're going to hear me talking about those as we get a little bit further into it, but I'm a firm believer in credit fitness because if you have a good understanding of what's in your credit report, it's going to make the process a lot better for you. Okay. So let's talk about the score. So you've got the credit report, as I said, from the 3 national credit reporting agencies. And then you have the score ranges. So everybody likes to know, how do the score ranges work? So they range from 300 to 850. 850 is the high, 300 is the low. In my 30 years in this business, I've never really seen more than 1 or 2 scores above 820. Those people, I think they would be called a statistical anomaly, which means there's just not a lot of them. We provide the credit reports to the lenders. And generally speaking, where we get involved is we try to improve the scores, anything that might be like a 580 all the way up into the 700s. We have a simulator that allows us to provide insight into the credit file and offers suggestions to improve the credit score. Excuse me, it's the credit scoring improvement is usually done over a time period. And if you're working with a real sharp lender like Shervin, what will happen is that simulator is provided. And I know that he spends a lot of time with his applicants trying to help them improve their credit scores. So it's a pretty simple process. And as you'll see, as we keep getting further into this, you'll learn a little bit more about it. So what happens with your credit score? How is it calculated? That's one of the main questions I get. So FICO, that's an acronym for Fair Isaac Company. They are the company that provides the credit scores. And with them providing the credit scores, they have factors that they use to calculate the credit score. There's 2 main factors that have the biggest impact on your credit score. Number 1 is your payment history. So if you're paying your bills on time, that's a very positive thing. And then the second item is your amounts owed. So specifically, we like to look at the balances to the available credit on your credit cards. Okay, so that's a lot. So let's talk a little bit about that. So a credit card is also known as revolving debt. Okay, and the biggest factor in a credit score is the revolving debt, and more importantly, how the balance is versus the available credit. So just to give you a little bit of a thumbnail, if you had $1,000 available credit and you have a $700 or $800 balance, that's going to have a little bit of a negative impact on your credit score. However, if you have an available credit of $1,000, and a balance of like say $100 or $200 less, that's a very positive thing. So that how you're managing those balances on your credit card accounts has a lot to do with your credit score. And quite honestly, it's the biggest factor. The second biggest factor after how you're paying your bills. The other 3 elements are your new credit, your length of your credit history, and your credit mix. They're very important, but altogether, in the grand scheme of things, they're a little bit less than paying your bills on time, and then also your available credit and your utilization really is the industry term that we use on your revolving accounts. Okay. So it starts with an inquiry. So when you make a mortgage application with a lender, they'll give you a credit application. You'll fill it out, you'll turn it in, and then they'll pull a credit report. That's called a hard credit inquiry. Okay. The other type of credit inquiry that's out there is a soft inquiry. A soft inquiry is something that will come out of primarily two factors. One is an existing account relationship that you may have with a credit card company. In their documentation that they provide you when you become a client, they have the right to pull your credit report once every a year. Usually is about what it is we see. That's a soft inquiry. Also, a soft inquiry is also when you see a consumer that gets selected for a pre-approved offer of credit. So when you go home at night and you open your mail and you look at your mail and you see that you were approved by Capital One or one of those types of clients, that means that you fit into a criteria that they had. They ran a soft credit inquiry on your file, and you met their criteria, and they're making you an offer of credit. So that's the difference between a hard inquiry, and a soft inquiry. Okay. So the next question we get a lot of is how much of an impact will an inquiry have on my credit score? Short answer is not much. Okay. Usually within 30 days after your credit report has been accessed, and specifically in the case of a mortgage, your score is going to go down by about 5 points. Not terrible. It's just part of it. Sometimes people are hesitant to have their credit report accessed because they're concerned about how it's going to have an impact on their score. So really, the thing to really focus on is it's about a 5 point hit, and it's about 30 days after the fact. Now, one thing that we do know from our reading and our experiences with FICO is they put a lot of good information out there. And one of the things that they let us know is if someone's out there getting a lot of credit inquiries on their file, and in their terms, if you have more than 6 inquiries on your credit report during the course of a year, there's a real high likelihood that you're going to be headed towards bankruptcy. And what they say about that is really what it comes down to is if someone's out there shopping for a lot of credit, they're probably out there looking for a lifeline. Okay. And then one other thing that we also like to let everybody know is if you're doing a certain type of shopping, whether it be a car loan, whatever it may be, when you have those kind of shopping times, for instance, if you went to a car dealer and they ran your credit through Toyota, GM, whomever it may be, as long as that's all within a tight time frame, is probably a 30-day time period is the best to look at. It's going to be treated as one inquiry. So you will not get penalized for being a shopper, if you would. Okay. So how can you improve your score? Okay. There's a couple of things that pop up that really make it a common sense type of thing. So paying your bills on time, as I started at the beginning, is keep your balances low on your credit cards and apply for credit only when you need it. Okay. If you do have some issues with your score, all is not lost. We can improve the scores. We're very fortunate that we have access to a simulator, which will allow you to see where your score can be improved and how it can get there in some, probably a tight time frame, as much as 6 months to a year or even less. You'd be surprised what you can do. Getting back to the credit fitness information that I was talking to you about too, annualcreditreport.com is a great website. It's a free service. Consumers can access their report weekly through 2023. That's an outgrowth of what happened with COVID. So consumers can get their report for free. Now, you have to realize that when you're actually going to get your credit report through annualcreditreport.com, they're going to test you to make sure it's actually you. So they will ask you some questions along the way. For instance, in 2012, did you live on this street? What was your address? Or in 2010, you had a car loan with this bank. Which of these banks did you have a car loan with? So credit fitness, annual credit report is really the first one that I would take a look at if I wanted to get a feel for what's going on with my credit report score. Okay. So what actually is going to have a negative impact on your score? It's obviously a recent late, any kind of derogatory trade lines that you have out there from the past, high balances on your unsecured debt, your credit cards, or your revolving debt, depending on how you want to look at that. Once you get up around 60, 70, 80% of a balance versus an available credit, it's going to have a negative impact on your credit score. Okay. If you have any public record information out there that's negative, that's going to have a negative impact on your score. And believe it or not, if you have a lack of open active trade, that will have a drawdown on your credit score as well. Okay. So let's talk about how you can actually improve your score. So we see a lot of different things in our practice with the lenders that we work with. And one of the most easy and fastest way to improve your scores is if you have maybe you have a little blip on your credit report. And the best example I always give is, like, say you have a Macy's card and you were late one time. The cards that you get from the department stores, if you would, they're very willing to work with you. So for instance, if you had an issue as a one-time late, you could often pick up the phone and talk to them and say, hey, I had an issue. It was one time. It's probably not going to happen again. Can you give me a courtesy removal? And clearing up a recent late in a situation like that, it's probably worth 50 or 60 points to your credit score. But you have to ask. That's the most important thing. We see a lot of collections on credit reports, sometimes rightfully so, and sometimes in error. Credit and collection agencies can have a very significant impact on your credit score. So we always advise people, if they want to have a conversation with the collection agency and say, hey, I'm willing to pay this, but I'd like to have it removed from my credit report, they'll often work with you. That could be as much as 100 points on your score. Okay, so as you're starting to see, if a couple of these things are starting to happen and turn up in your situation, well, there's an opportunity to get in there and clean it up. It just takes some proactive approach on your side. The magic number on revolving debts is you get those balances below 20% of the balance. So for instance, as I said before, if there's $1,000 balance, $1,000 available balance and a $200 balance, that's really going to optimize your score. So sometimes we advise people to transfer balance between cards if they have a situation with little or no cash available. You can make it work. Just get those balances below 20%. Student loan payments. We see a lot of student loans that are in deferment that should be being handled properly, and they're not. And a late on a student loan could be a negative, a very, very negative thing as the calculation of your credit score is done. So we do see a lot of those that pop up. We do spend some time advising consumers, get in touch with your servicer, get the documentation, and we get this all straightened out really quick. Installment loans. Installment loans have little or no impact on your credit score as long as you're paying them. So if you were thinking about paying off an installment loan with the hope of improving your credit score, it's not going to help. We advise clients to maybe go ahead and use that money for something that would have a little bit more of a positive impact on their score, such as revolving debt or any other type of things that might be out there. But an installment loan is not a path to an improved credit score if you're paying it early. Okay. So as I said earlier, with the credit fitness, the second best tool I think out there is Credit Karma. So 1 out of every 2 or 1 out of every 3 people in the United States, somewhere in between, have a Credit Karma account, and it's an awesome tool. It keeps people in tune with what's on their credit report. It's a free service. You can check it as often as you want. But there's a couple of differences that exist out there. Mainly in the mortgage industry, we do not use a Credit Karma score. We use the FICO score version 8. Credit Karma uses a score called the Advantage score, and it's not the same score. It's a different calculation. Score ranges are the same, 300 to 850. The credit bureaus that are actually being scored on FICO versus Credit Karma score are different. Experian does not score on Credit Karma. The score factors, as you can see, that's from the slide that I talked to you a little bit earlier. FICO is very tight. They're very specific around how they calculate their scores, whereas Credit Karma is a little bit different. Credit Karma uses terms like highly influential, moderately influential, or less influential. Credit Karma will consider rent and utility bills in their score calculation, whereas FICO doesn't. Here's the most important thing to understand between the two of them. A FICO score is going to score about 30 points less than a Credit Karma. Another quick question I get about that quite often is my bank or my credit union has a credit score that's on my bank statement every month. Can I take a look at that score and understand how it works in mortgage? And usually when you're in a situation like that with one of those banks or credit unions, the score that they have, they'll put right underneath the score what version they're using and what score it is. So if someone has a Credit Karma score of 790, chances are their score on FICO version 8, which we use for mortgage lending, is going to be about 30 points less. Okay. It's a very, very important factor to discern when you're going through the process. Experian Boost. Shervin and I had a little conversation about this morning. Experian Boost is a great tool for building credit. So if someone has a thin credit file, Experian Boost is a great tool. Experian Boost is really meant to try to help with people that are trying to gain, maybe for instance, a cell phone or a car loan or whatever it may be. The thing to remember though is that with Experian Boost is it does not calculate inside of the mortgage score. So it's not going to be considered. Sometimes it could be a little bit of a problem in the mortgage process with that debts that are being recorded, logged into it. the way that works is your bank or your credit union will give access to Experian Boost, and they'll capture the monthly payment so that they have like a little bit more information on the credit file. Experian Boost is a great tool, but it doesn't really work very well in the mortgage space. A couple last items. Rental information. Rental information is a very important part of the mortgage process. However, the rental payments that people make to their landlords don't make its way into the credit score. It is, as I said, a very important factor, but it's not going to improve your credit score. There was some information out there recently that said that was a factor in the score, but that's not accurate. Okay. Medical collections. This is one of the best things I've seen in all the years I've been working in this business. Paid medical collection debt can no longer be included on a credit report. And what we've seen in the past is someone might get themselves into a situation where they have a $87 dental bill or something like that, and it got sent to a collection agency, and the collection agency would accept the payment, but then they wouldn't remove it from the credit report. Bad. That's 50, 60, 70, 80 points on a credit score when that's hanging out there like that. And the credit bureaus, Experian, Equifax, and TransUnion got together and they said, we don't want that anymore. We want those off the report. So that's going to be a great benefit to consumers that unfortunately got tied up with the collection agency. Medical collections, the bureaus also made a change, and they said it's going to take a year to start reporting. That gives the consumer an opportunity to work with the collection agency to get that straightened out before it becomes part of their credit report. And then in this year, I believe it's starting March 31st, medical collection debt of less than $500 will not be on the report anymore. So once again, there's a big benefit to the consumers that's popped up because of the medical collections and how they're being reported. So there's a lot of positive ways to impact the credit score. A lot of it is making sure that you're asking the right questions. But the thing I always like to come back to is if you start this whole process with a mortgage professional like Shervin, they'll get your credit report, they'll get the right score, they'll look to see if there's score improvement, and they'll guide you through the process. This is not something you want to try to do on your own. There's a lot of great information out there. As I said before, the credit fitness is very important. However, credit fitness should be taken as an awareness and not necessarily something that you try to do on your own. You got to start with a professional, a mortgage professional. Last slide, a couple of websites for consumers if they have a need to get in touch with the credit bureaus. Their 800 numbers are there. They're very concerned about doing a good job for the consumer, and their information is there. They're really good people to deal with. Annualcreditreport.com, as I talked to you about earlier, that's a good place to get a copy of your credit report. And the last item is something that's become really relevant in recent times. It's called optoutprescreen.com. And what we like to do is we like to tell consumers, get involved in that. Get your information off of the national database. And really, there's two benefits to that. One is you're not going to get those approved offers of credit in the mail every night, which really will help you. The second part of it is it'll help you avoid any type of situation that might present as far as identity theft. Identity theft is real. I got a text last night from my credit card company that said someone was trying to get into my credit card, and it wasn't me. It wasn't my wife either. So that kind of stuff exists. But the more that you could prevent it through the right tools that are out there, such as Opt-out Prescreen, the better off you'll be. So that's essentially what I have as my presentation. As I said at the beginning, my goal is to hopefully clear up some of the concerns that people might have about credit reporting and credit scoring, and also point you back to the fact that you really should start with the mortgage lender. That's where it all starts, and that's where we can get a lot of things done. Thank you.
Thanks, Sean. Outstanding as usual. Always great stuff. It never gets old. I always learn something new, and we've been doing this forever. Just compelling stuff that affects you in every walk of life. It's not just for mortgages. It's not just for purchasing a car. It's not just for credit card. You have to understand that your credit score dictates how much money that you spend on a daily basis when it comes to your cards, financing, and it doesn't have to be a big ticket item, but all the items you put on that credit card, just think about that. If that is a low rate because your score is so high, you're saving gobs of money, and that's important. But it's just fascinating to me how people could neglect and then come back and see all the money wasted on high rates and so forth. So you have to care. You have to really take ownership of your credit situation. And as Sean said, credit fitness is everything. So thanks, Sean. Really appreciate it. And now I will put my presentation up and I will share with you. Here's my contact information. If you need to get in contact with me, my number is 571-278-8351. I am at SHIRVAN.Joseph, JOSEPH, at FitzgeraldFinancial.net. Now, I was going to just field questions tonight, and I thought, let's go back to the Mortgage 101 and run through this for anyone that's missed it, because I know in the past people have said they missed it. And it's right here on the Washington Informer's page. So any past shows that you might have missed, you could catch up with them on the Informer's webpage. So why choose us? Loans tailored for your needs, personalized service, your own private concierge, which is me, competitive rates. We're pretty aggressive as far as rates are concerned. We close on time. Matter of fact, I like to think around the Beltway, we've kind of upped the ante on other lenders on the speed, because we close loans in as quickly as 10 days, 2 weeks, 3 weeks, whatever you need. But our main and number one priority is to ensure that we're ready to close and we're waiting on you. So if you're thinking of buying a home and you're comparing your options, no control of your rent increases, a lot of talk, and particularly tonight, I noticed on the news that rents going up astronomically all over the country. And you're paying somebody else's mortgage, pretty much. And that's not a good investment for you. No tax deductions for your rent, no privacy. You're limited to the ability to personalize your home. And you and I both know that anytime that you rent a place, whether it's a house or apartment, the landlord or the owner wants their property back the way you received it. So you have to spend a bunch of money because you might have been there a number of years, and you got to paint it to the way they wanted it back and get rid and clean up and do everything. And you don't have to worry about that with your own house. You're building equity. You have a tax deduction. There's zero down payment options, which I will discuss as we get into the presentation. You customize your home to your needs, how you want your home. And there's fixed payment options. So you don't have to worry about your payment going up on an annual basis. And the questions you have to ask yourself is, are you ready to buy? Do you have steady income? Do you pay your bills, including your rent, on time? Do you have low to medium debt? Do you have the ability to make the mortgage payments? Do you have okay to good credit? The importance of a pre-approval, because everything starts with that. The same thing as I said, through the process, credit is everything. Well, really, the pre-approval comes first. We find out about your credit, and as the process goes through, you go through all the different cycles of the process. But boy, that pre-approval really enlightens you. It sets realistic pursuit for properties. It strengthens your buying power. You understand the difference between what you qualify for versus what you really can afford. Understand the loan programs and how to use them to leverage your purchase. Review your credit for accuracy beforehand. You just heard Sean talk about that, and that is so important. So, you want to obtain a yes or when on a loan application. Understanding the differences between what you qualify for and what you can really afford. Just because you qualify for something on paper doesn't mean that it's what you really can afford. Don't forget that you will have other bills associated with the home. So you always have to prepare accordingly. A nice budget is always good. So the qualifying factors, the four C's: capacity, credit, capital, and collateral. Income, capacity to repay the debt based on your earnings and employment history, expenses of dependents, and other obligations you have. Credit, history of how much you owe, how often you borrow, and if you pay your bills on time, and if you're living within your means. Assets, capital or the amount of cash you have for a down payment and settlement costs, as well as cash reserves to deal with repair or replacement expenses that may arise after you're in the home. Property, collateral to protect the lender's investment if you can't repay your loan. The home you buy must be worth enough to back up the loan. So, what factors affect your monthly payment? Rates. We were talking about that. Rates, how credit affects your rates. Ask the lender for their current rates, mortgage interest rates. Interest rates change daily and can change throughout the day depending on the market volatility. And we've had a lot of that in the last 6 months or last year for that matter because of the hint of inflation. Ask the lender when you can lock in a rate to avoid increases to your payment. Typically, this could be done at the time you have a ratified contract. That is absolutely correct. Make sure you lock on make sure your lock on your interest rate is locked in until the day you close on your loan. So you don't really want that lock expiring. That's why we close so quickly. So we never have to worry, and you never have to worry about having to pay for an extension. If it does happen, it's because something that happened between you and the seller and not because of us. Origination points or discount points are fees paid to the lender for the loan or can be linked to the interest rate. Usually, more points you pay, the lower the rate. Ask for examples of payments with points and without points. I'm here to tell you that 95% of the time, unless requested by the borrower to buy down the rate, I always offer a 0 point loan because that money, the money to buy down the rate, unless you want it, could be used to do other things like your reserves after closing to prepare yourself for your move and all the other things that you have to prepare yourself for, or just the funds for closing. This will just give you a better idea of paying points if it's beneficial or not. Down payments and mortgage insurance. So some lenders require 20% of the purchase price as a down payment to avoid private mortgage insurance. Government loans such as FHA and rural development will have mortgage insurance no matter the down payment. Most lenders have options to buy out mortgage insurance no matter what the down payment is on a conventional loan. This may increase your interest rate, but in the end will result in a lower mortgage payment, a lower monthly payment rather. Homeowners insurance and property taxes. So your payment, your monthly mortgage payment is made up of, it's called, the acronym is PITI, principal, interest, taxes, and insurance. So the interest rate, we just talked about principal and interest. That's your basic payment. Then there's homeowners insurance and property taxes. Lenders will typically require these items to be included in your monthly mortgage payment. These payments are deposited in an account at the mortgage company called an escrow. When comparing monthly payments with different lenders, ask if the payment includes monthly taxes, insurance costs in the payment. Very important. A payment should consist of principal and interest, real estate property taxes, homeowners insurance, and private mortgage insurance. And if there's no mortgage insurance, then it's just the principal, interest, taxes, and insurance. So which mortgage is right for you? Mortgage options includes conventional, which come at as low as 3% down, FHA, which is as little as 3.5% down. A little bit more flexibility there with an FHA loan with regards to credit and debt to income ratio. Renovation loans, which from my experience and my preference, I think the borrower should have some history of home ownership before jumping into a renovation loan. However, we have them, so it's a purchase of home and the cost of the rehab of the home, because there might be repairs that need to be done that the seller's not willing to pay, and you don't have the money to pay for that because you don't own the home yet. USDA loans, perfect for rural buyers with up to 101% financing. So I said there were 100% loans earlier, no money down options. USDA is one of them. And VA loans, if you've served your country, 100% financing is available. I am also a veteran of the Marine Corps, so you would be in good hands if you're a veteran looking to take and utilize your VA entitlements. So we just discussed the conventional aspect of the loan, 3% down, as little as 3% down. Typically, you'll see 5% down, unless you have 20% mortgage, private mortgage insurance is needed. And it comes with fixed rates and ARM options. I'm a fixed rate guy. I just totally believe in the market it's still a relatively good market, and I'm not giving or putting anyone into an adjustable rate mortgage at this time. FHA down payment as low as 3.5%. You can use gift money for down payment, and gift money could be explained as you could get money from a mother, father, sister, brother. Everything as far as money is concerned has to be paper trailed on a conventional FHA, VA, USDA. You must paper trail everything. So a gift, we will give you the gift letter, and we'll need documentation to back it up with the gift. Less strict debt to income ratios, as I stressed earlier. Lower credit requirements. And as I said, the 203K FHA 203K loan can be used to use toward improvement. A VA loan, no money down, no costly mortgage insurance. It's a VA funding fee, limitation on buyer's closing costs. The seller could actually pay all of the cost on that particular loan if you find a seller willing to do that, where you could walk into the property with no money out of pocket. It's a lifetime benefit and can be reused. So if you sold your last house that was a VA loan, you could just turn around and use your VA entitlement again. It's a great instrument, particularly, since you served your country, you should utilize it. USDA guaranteed rural housing, helping borrowers achieve the American dream with zero down payment and minimal investment. 101% financing for qualified to moderate income families. This is an income-driven and income-qualified program. Ideal for borrowers with little or no cash, so there's no down payment. And if you get a seller that could pay your closing costs, again, you could potentially walk in there with no money out of pocket. Low upfront fee, low monthly mortgage insurance to be reduced based on principal balance, flexible debt to income ratio, and reasonable credit requirements. It's just a great instrument to use to get into a house. So there are grant funds. Grant funds is something that you could get from the state or different entities from different counties with regards to assisting you in your down payment or closing cost assistance. I'm just going to scan through these. This is the Maryland Mortgage Grant Assistance. I believe it was last week we discussed the grant programs. So there is a presentation on the Washington Informer with regards to grant programs. Sparked by 3.0, again with Maryland Housing, DC Open Doors, and then that obviously is a grant program in the District of Columbia. Minimum borrower income 151,200. FHLB grant options. Their grant programs at 12,000 and 15,000 for community, 12,000 for first-time buyers, 15,000 for community partners, law enforcement, firefighters, teachers, etc. That money came and went. We should be getting another allocation in June. Virginia has the VHDA funds as well. And so there are grant programs out there. Please understand, in some cases of grant programs, the rate is a little higher than the rate that we would give you without a grant program. And we will discuss that with you on a case-by-case basis. Student loans, big topic around the country. How do you determine on qualifying? Well, a lot of people think because their loan payments are deferred, whether they're still in school or not, deferred payment to the lender means that we have to put a minimum payment in there by regulation. So when we say a minimum payment, it used to be you have to put 1% of your student loan balance. If you had $100,000, then it would be $1,000. So now it's 0.50% or 0.5%, which for a $100,000 loan, it's about $500 in minimum payment. So it's a big difference. And now, the great thing is in the last couple of years, income-based repayment plan from the student loan company. So if you're on an income-based repayment plan, and that usually means that the payments are extremely low and you have documentation with your student loan entity, then you're in great shape. We're just going to take your documentation and have the credit bureau add that payment on, and it will probably put you in a better position to qualify for more house. The next few slides are regarding credit, and you just saw the best in the business do a credit presentation. So I'm skipping all of that. And then we come to the don'ts, the home buying don'ts in purchasing a home. So these is a guide that I really live by, and I know a lot of mortgage bankers and a lot of banks and mortgage companies and realtors live by this because we've all experienced this with buyers. And while it's common sense, it still falls on deaf ears because, folks are going to try the system. Number one, do not change jobs, become self-employed, or quit your job. Certainly, if you're making more money and so forth, you discuss it with your loan officer. With me, if you're making more money and you have documentation of your offer letter and it's going up and so forth, yes, by all means. But if you're doing a lateral move, I would probably tell you, you don't need to be jumping ship right now. Let's just wait and get your house and so forth. Number two, do not buy a car, truck, or van. It's not a good place to be when you have a payment $500, $700, or $800, and you do that in the middle of the loan process. You probably won't be able to qualify for the amount you qualify for. So that should be something discussed again with the loan officer prior to indulging yourself in a new purchase of a car. Number three, do not use charge cards excessively or let your accounts fall behind. A lot of people feel that because the credit report was pulled, that you are free to binge and start charging and so forth. Folks, I'm here to tell you that just about every mortgage company does a soft pull on your credit a day or two before closing to make sure there's no additional debts. So you don't want new debts cropping up preventing you from qualifying for the mortgage. Number 4, do not spend money you have set aside for closing. No quick trips to the Bahamas, to Cabo. Get your house and then take your trip after for celebration. Number 5, do not omit debts or liabilities from your loan application. We're going to find out there's lots of mechanisms that we use and underwriting use to make sure we've got everything covered. Number 6, do not buy furniture. Save the furniture buying after you have the keys to your house. Number 7, do not originate any inquiries on your credit card. Again, with all the software that it goes through compliance, through underwriting, there's enough there that we could see whether or not there's no inquiries, which you will have to explain. And hopefully those inquiries didn't lead to new charges, which could prevent you from qualifying for a mortgage. Number 8, do not make large deposits without first checking with your loan officer. Any large deposit over $500 has to be explained. As I said earlier, everything has to be paper trail. So it's critical that you avoid any large deposits. Anything with cash could kill a deal, because if it's not paper trail, we cannot use it. It's industry-wide. This is not exclusive to us. And number 9, do not change bank accounts or move money from in between accounts. Number 10, do not co-sign a loan for anyone. Look, when you co-sign, you have become the owner of that debt. A lot of people think, well, yeah, I just co-signed for him. It's not going to show up. Yes, it is. It's going to show up and will, and could and will in most cases prevent you from qualifying for the mortgage. So those are just 10 home buying don'ts that hopefully you'll hear to. And again, they're all common sense approach to how you approach getting a mortgage. And if we're going to close you in 10 days, 2 weeks, 3 weeks, I think you could, you make sure that you don't do anything radical that could prevent you from getting in a mortgage. Again, my contact information is on the screen, and it's been a pleasure presenting this to you. And if you really want some, as I said, there's a lot of presentations on Win TV. However, Sean and I recently did a questions on credit from a Gen Z buyer. And that's very important because this is coming right from the Gen Z potential buyer. And she had a load of questions, and it'll be released tomorrow on Spotify. Sherv Speaks on Spotify. Credit month is in March, and so that'll be released tomorrow. Just something to look forward to. However, this presentation, like all presentations, will be on the Washington Informer site. So thanks again for tuning in. We appreciate it. Hopefully we made a difference for you. And if you need me, my contact information, again, is within the system and is on the Washington Informer's page. Sean, thank you so much for participating and giving a great presentation with regards to credit. And thank you, folks.